So earnings season just started, and these 5 stocks that I'm gonna talk about are about to report earnings, and they have a massive chance to beat their numbers, and on top of that give a great guidance. It's even more important to know that these companies have a bright future and long-term growth. So for each of these stocks, I will be showing you the analyst forecast of their revenues and EPS numbers for the years until 2028, as you can see over here in the Excel sheet. So it's extremely important to do your projections so you know how attractive stocks are and when you have to sell them, obviously. So the first stock of the 5 that is extremely likely to beat their earnings is called Applied Opto electronics, because with these expected revenue numbers and with these EPS numbers, the stock price in 2028 will surge between 160% and 330%. Well, if you ask me, that's a great return over 3 years. Now let me tell you why this company can beat their upcoming earnings by a massive amount. So first of all, AAOI just started their turnaround with major AI cloud customers, because this company is providing products that's enabling rapid data transmission, which is essential for cloud computing and hyperscale data centers. And this company gave their own EPS guidance of minus 10 cents and at most $0.01, while the analyst forecast is definitely looking more bearish, so more towards that minus 10 cents. So that's setting up for a very easy EPS beat. Furthermore, potential tailwinds could be multi-year AI data center contracts, and Microsoft is definitely in the picture right now, which is a good sign. And on top of that, they have 2 very fast growing products, which are called 100G and 800G, and these are accelerating their growth even more. Apart from that, are insiders literally buying their own stock? Last quarter that was $1 million, which is a very positive signal. So basically why it will beat is strong customer demand, raised guidance, and conservative market expectations. So at least put this one on your watch list. The next stock that's about to destroy their quarterly results is called BTDR, also known as BitDeer Technologies, which is a crypto miner that is turning into an AI infrastructure player by transforming their Bitcoin mining centers to data centers and by building entirely new data centers. And you can see that in their forecasted numbers. If you look at the Excel sheet and look at their revenues for the coming years, they will be growing their revenues pretty fast, and same counts for their EPS. And if they realize those numbers, then the stock price of this company will increase between 107% and 246%, which is obviously a great return. Now looking at why this stock can absolutely obliterate coming earnings, the first reason is because analysts are very bearish. They're expecting revenues of 153 million, and the last quarter their revenues were 155 million. So there will be a decline if you compare it to the previous quarter. The positive point is that self-mining rate has doubled, so that resulted in very bullish numbers for the month of September. Analyst sentiment is right now a moderate buy, with price targets between $16 and $18. The stock price right now is $24, so that doesn't really make sense. So that shows you that analysts are pretty bearish on this stock, and that they still don't fully understand the complete story of this company. And their possible tailwinds is rising Bitcoin prices and basically their entry into AI cloud computing, which is luckily not yet priced into their valuation. The first stock of the 5 that has a massive chance of beating their quarterly results is called Upstart Holdings. I talked about this stock in this video, and this company is an AI lending platform, and they're growing their revenues pretty fast. If you look over here, within 3 years their stock price will increase between 130% and 280%. That's more than enough growth if you ask me. And when I talked about this stock in my previous video, where I talked about the best AI stocks to own, I also talked about Upstart Holdings, but I warned you guys to wait for a better entry point, because at that moment it was trading at around $66, and you can hear me say wait for a bigger drop. So that was definitely some valuable advice, and for that reason I would greatly appreciate it if you would smash the like button for me. And right now I'm buying this stock heavy. This stock recently declined almost 50%. I would definitely recommend you to open a position here if you haven't already. But the real question is, why could this stock absolutely destroy analyst forecasts? So first of all, they're expanding their business into car and small business loans, and furthermore they're improving their credit performance and AI model accuracy. And their tailwinds are that rate cuts will be improving borrowing conditions, they have new banking partnerships that are increasing loan volume, and all this will likely result in an earnings beat. And trust me, not by a little. The 4th stock that could potentially smash earnings is called Harrow, and they are a special pharma company that is focusing on eye treatments. If you look at my Excel, they will be growing their revenues rapidly, and this results in very bullish upwards potential of 112% increase to possibly a 400% increase in their stock price over 3 years. Now, why has the stock the potential to beat the upcoming earnings? Well, first of all, if you look at the analyst sentiment, there are 8 analysts with a strong buy recommendation with an average price target of $68. And these were pretty recent price target hikes across multiple analysts. So that's really showing the shift in analyst sentiment. Furthermore, is the company doing a great job of integrating the recent acquired company, which has a massive drug portfolio, which is resulting in new product launches and accelerating sales. And the tailwinds are aging population, increasing demand for affordable eye care, and with EPS expectations extremely low relative to recent performance and product momentum, sets this company up to have a massive increase in their stock price on earnings date. The 5th company is called AMD, and this company will absolutely obliterate their guidance. And you got to own at least some shares of this company if you want to have some nice gains in your portfolio. So first of all, looking at the calculations of my Excel sheet, this is pretty, I would say, even bearish. This is what I could find on what the analysts are forecasting for the coming 3 years. But these revenue growth rates are nothing, and I truly think that their average revenue growth will be 30 to 40% plus. So we can basically take this as a bear case. And if you look at the returns over 3 years, even in this scenario, which is not that bullish, you will have great returns after 3 years, which is between 138% and 257% increase. But I want to mention this stock in this video because in my opinion it will obliterate their guidance. Because first of all, their tailwinds are strong AI demand and data center momentum. They recently got major customer wins like OpenAI and Oracle. They're reporting record PC and gaming segment growth because last quarter the PC revenue went up 67% and the gaming revenue 73%. So those are massive growth rates, even though it's a smaller portion of their total business. And yeah, for their guidance outlook, they will likely guide Q4 higher, driven by ramping MI300 AI chips. And the analyst sentiment right now is getting pretty bullish, but honestly, with the highest price target of $310, it looks like they still don't understand what's coming. Now smash the like button if you want to know all the stocks on my Excel sheet and what their potential growth over 3 years might be.